U.S. oil inventories, as we just told you before the break, rose by 1.96 million barrels last week. That was versus an expectation of a sizable drop in supply. For reaction and analysis of the oil market, let's bring in Andrew Lipow. He's president of Lipow Oil Associates. He's joining us from Houston, Texas. Andrew, thanks a great deal. Put these numbers in context for us. So the market was expecting another drawdown. It got a fairly sizable addition. How does this fit into the larger supply-demand picture in the U.S.?
Well, I think we have to look at the crude oil inventory in conjunction with what happened in the Strategic Petroleum Reserve, which saw an all-time record weekly decline of 7.7 million barrels. So all told, the crude oil inventories actually drew over 5 million barrels over the past week. And in fact, Cushing inventories are now roughly 50% of what they were last year. And I think this is going to further support the oil market. What we're looking at right now is how is the Fed decision going to impact prices?
And take us through that narrative. How would the Fed decision affect prices? The Fed decision, of course, could, what the Fed wants to do is slow down the economy and slow down demand in the economy. Is that what you're talking about?
Well, exactly. If the Fed were to increase the interest rate by 75 basis points, of course, that's going to result in a stronger dollar. And because oil is priced in dollars, it has the effect of weakening the commodity prices. So I think that a 75 basis point rise in the interest rates will temper further increases in oil prices. But the oil market is really beholden to the supply situation around the world. And that's really been further exacerbated by Libyan oil production now falling 1 million barrels a day.
And so what, with all those moving parts, what is your call on crude oil over the next 3 to 6 months, let's say? We're now at roughly 118 US dollars per barrel.
Well, I think oil prices are going to continue to drift up higher because we're simply seeing oil inventories around the world continue with their decline, and especially with the Saudi Arabia reluctance to increase their production to make up for OPEC Plus's shortfall. It gives the bias to the upside. But I do believe that President Biden's trip to Saudi Arabia next month is significant. I would be expecting that Saudi Arabia would loosen its grip on oil production, and we could see additional barrels show up.
That's interesting because I know you are on record, as are some others, as saying that U.S. President Joe Biden's attempt to talk down the price of gasoline by talking aggressively to the chief executive officers of oil companies is unlikely to have much of an effect.
Well, I think that's right. And the two things that the administration could do to reduce gasoline prices, they have so far not done. The first, of course, is to suspend the federal excise tax of 18 cents a gallon. But the other thing they could do is ease the environmental regulations on the type of gasoline that's sold in the country. If they move to, say, a springtime formulation, not only is that cheaper to produce, but it could increase supply dramatically and further reduce prices.
He says in his letter that he wants to know why the big oil companies and refiners, more to the point, have cut their capacity recently. What type of answer is he likely to get there?
Well, I think the answer is if you look back 2 years ago in the throes of the pandemic, demand declined precipitously. And as these refineries are getting older, they require more investment and more capital expenditures to keep them going for the next 30 to 40 years in an environment that in the United States is moving away from fossil fuels.
Let's move to natural gas. The big event there has been a fire in Freeport, Texas. I said a couple of moments ago that it would take weeks for that facility to be back online. I think it's more like months to be back online, perhaps towards the end of this year. That, of course, is having a material effect on the natural gas market in the United States. That facility in Freeport, Texas is a LNG export facility that would take U.S. natural gas, liquefy it, and then ship it, I believe, to European markets.
Well, in fact, the Freeport LNG facility accounts for about 15% of our LNG exports, and Freeport LNG did come out earlier and said that the entire facility is going to be offline for about 3 months, and it won't reach its full capacity till the end of the year. And of course, that has really played havoc in the natural gas prices, which had recently peaked near $10 a million BTUs and have now fallen about 25% since this announcement. One thing I would point out, it just shows you how much more the United States natural gas market is connected to the rest of the world's LNG market, going along the lines of how the US and Canada are really connected to the world's oil and refined products markets.
Yeah, you mentioned, let's circle back to the international market in oil. You mentioned Joe Biden's trip to Saudi Arabia, and you thought that it will likely result in some more Saudi barrels on world markets. What about OPEC or OPEC Plus's so-called spare capacity, the additional production capacity they've got, the degree that they are able collectively to open the taps more broadly? How material is that spare capacity to the market right now?
Well, the only three that really matter are going to be Saudi Arabia, the United Arab Emirates, and Kuwait. And even though Iraq has been mentioned, they are limited in their export capacity to load vessels. So given that OPEC Plus is already missing their production quota target by 2.6 million barrels a day, and that's only going to get worse as they increase their quotas in June and July, it's really going to be difficult for OPEC Plus as a whole to reach their production quotas, especially as we're seeing Russian production decline.
And finally, let's jump back to the price of gasoline. You think that the idea of price controls imposed by Washington are a very bad idea, and you've got some examples that bear that out.
Yeah, this is just a terrible idea. You know, we've seen price controls in the 1970s on crude oil, and crude oil production did nothing but go down over the next 10 years. If we look at price controls down in Argentina, where the domestic diesel price is 30% less than the international price, what results is imports don't show up in their domestic market. If we had price controls here in the United States, what we would see is imports would slow down into the East and West Coast, really starving their markets. I would also say that if we had price controls here and the price of WTI went down, Canadian exporters would rather send their oil to Europe and Asia rather to the United States, creating shortages, especially in the Rocky Mountains and the Midwest.